Namaskar and welcome everyone to our show on ideas about finance, tax, accounting, and audit. We have been talking to various experts in all these different fields over a period of time. One of the areas of finance that we have chosen is funding, and we have Tejas Sanghavi in this show. We have already had him before in the show, one of the shows before, in uh, basics of how the funding looks like and what is the idea of funding for the entrepreneurs and how one can start and get into the funding process over a period of time. One of the points that is worth evaluating and discussing in this topic, coming to the subject proper, is regarding the debt versus equity. Generally, there are stages in every entrepreneur's life from inception till growth till listing and over a period of time maturing as a overall organization or institution. In that process, when all does one go for debt, and one when does one go for equity? This is the first question for Tejas bhai.
Yeah, hi Mitesh. So continuing to our first topic and all those things and getting into the further nitty-gritties of finance. A right question asked by you is nothing but what is the exact time and what is the right approach for the funding, whether you should go for a debt or for an equity. According to me, Mitesh, this is again very subjective, related to the industry, related to the promoter background, the vintage, as well as the wealth that they carry. But putting it in a general sense, what is the actual timeline or what is the thumb rule when people should look for a debt or an equity? So I would put here a few points on what are the pros and cons of equity. So basically, when do you want to actually continue with debt and what are the advantages of debt as against the equity? So just to put a thing in perspective, what is debt? Basically, debt is nothing but which you're taking from banks, financial institutions, as well as other HNIs. Debt by nature is obviously much cheaper in comparison to the equity that you take from the various again stakeholders like an HNIs or the venture funds. That is the primary advantage if you ask me about being on the debt side. This the cost of funds is much cheaper for that matter. The other thing that matters to a lot of promoters as well as small entrepreneurs is obviously the control over the business as well as the stake dilution, because it's obviously very near and dear to them. The way they have built up their business, the way they have built up the entire uh, this systems in their business and all those things. Once you are thinking about the equity and all those providers, there is a lot of dilution and everything is expected from that angle. So debt gives you that advantage. There is no dilution of stake, and also there is no loss of control over your business. You are the sole and the major stakeholder as well as the decision maker in the business. So these are the various advantages that debt carry over equity from a funding option perspective. But when I say this, obviously the reasons for public having challenges. So now when we have spoken about the pros of debt, obviously there are a lot of cons in debt as well. So when I move or when do people start thinking about equity is when there are a lot of challenges that they face in their existing business. The first challenge, obviously, the own capital that they already have is obviously exhausted in the business operations which they have already started. And to put it to the next stage, there is a limited availability of funds because of that. Now also there are regular repayments as well as cash outflow based on the product that you are. If it's a term loan, then there is an interest plus principal. If it's working capital, there is a flow of interest. So there is a cash outflow which is continuous and regular, which is going out of the business in a debt thing. Obviously, your balance sheet is much leveraged because the debt is obviously there on the balance sheet, because of which the balance sheet looks leveraged. So these are various cons of debt. Now, how do you then move it to the next decision making level? It obviously depends upon your growth potential that you're looking in your business. So today, if I have already exhausted all my capital as well as my collateral availability for taking funding from banks and all those things, and still there is a big growth potential that I'm looking at, I would say that there is a next growth level which is nothing but moving in equity. Now, when we say about equity, there are various options. So the equity obviously starts from say money taken from an HNI, which again could be in the form of equity where you are diluting a minority stake. It could be from private equity funds, venture capitalists, etc., etc. Now, what are the pros of equity? Why should people move into equity, and what are the reasons that they should vouch and the stage that they for moving for equity? As we discussed about the cons, so here the availability of funds is not a challenge. If you are having a big potential for business, if you feel that the exhausted limits have been exhausted and the growth that is required is not going to come from smaller pockets of debt, you are supposed to look from a higher amount of capital availability which comes from equity. There is no recurring repayment pressure, so you actually can plan your entire cash outflow. Obviously the return is going to be higher, which obviously will be taken in the cons part, but if you ask me, the major challenge by taking a debt is nothing but you obviously under the pressure of constant repayments by paying principal, interest, as well as the other outflows that go from a cash flow perspective. Balance sheet looks healthier because obviously there is an equity stake dilution. The money is coming in the equity part of the balance sheet. So the balance sheet obviously looks much healthier in the case of equity. Last perspective, why are you looking for an equity? It's not only about always money. So the value addition that can come from an equity partner. So if you are looking at a strategic investor, the guy can not only bring in money but also can bring in a lot of synergies in your business if he's coming from your business background. So there are various advantages of equity other than just the finance money coming in. So this is the process where people generally look for equity if the requirement is higher. If they are looking for a strategic investor where he can also put certain value addition, you do not want to put your balance sheet on a very leveraged side, and obviously you do not want to have the pressure of repayments on a continuous recurring basis. So these are the various advantages of equity. Now, obviously, there will be a con side of equity, that why do not people generally move for equity unless and until they have exhausted all their options for raising debt. So I would put it in a similar manner, the higher cost of funds. Now, today, if a debt is available, say in the range of 8 to 10%, equity does not come below 18 to 24%. So when you have the luxury of making repayments as and when needed, or after a particular period of time, say for that matter, 3 years or 5 years, whatever is decided, whatever you pay is going to be much higher than what you would have paid in the case of debt. So obviously, higher cost of funds is the major distraction or a major discomforting factor for a person to move into equity. Loss of control. Now, if you are taking a strategic investor, and obviously the guy has built this business over last 20 years, there is an emotional attachment, and there are a lot of other challenges which comes from another partner coming in, where there is a lot of I would say challenges in the decision making, difference of opinions, etc. So that is one thing that obviously is a challenge in an equity flow. And obviously you dilute the stake. Now that is again a very subjective matter, because dilution of stake is supposed to be done at a right time, and no one can define that right time. Everyone feels that we could have got a much more healthier balance sheet, and that could have been the right time for having a dilution of stake. So that are the general discomforting factors for the guys to move into equity. But to conclude on a comparison between debt and equity, a entrepreneur will obviously have to think upon various things that we discussed, that if there is a huge opportunity, if there is a opportunity which with all the means. Nice example here, we know about a client who is basically with a turnover of around 15 to 20 odd crores. They are into manufacturing of specialized walls, and been doing business since last 20 years. These are specialized walls with a very high volume business, with a high uh, return potential on the margins, etc. Now there is a sudden expectation of order from the ministry and from the Navy department, where they were expecting an order of around almost 200 odd crores to complete the proposal. Now, in this case, I do not see any possibility of debt coming in, either by uh, putting their collateral on stake or putting the capital in stake. So this is a pure example where you need a good, strong partner who can come in, who can understand the potential, and that is how you negotiate on the valuation of your dilution and can look at an equity. So this was just a small example of when can a person look at an equity, even though he is running his business well, but depending upon the big opportunity that we are looking at. So that is how it depends on what is the situation, what is the business potential when people actually move from debt to equity. Again, from a debt perspective, uh, the best option till the time you exhaust your options available for collaterals, for your own contribution, and all those things, you can run the business with much less cost of capital. Take it to an extent where you have a lot of assets built up or a lot of valuation built up in your profitability, and then looking at the equity could be a right option. So just to conclude, there is nothing as a right answer, debt or equity, depending upon the business proposition, depending upon the opportunity, people can take a call on the debt or equity.
Great. So let's look at another important aspect while we are looking at debt and equity. I think majority of the owners and companies which are in the range of say 5 crores to 200, 300, 400 crores,
Right.
the better option is going for a debt. It is also a cheaper option. It also puts company into a lot of discipline and structure while operating with the organized sector like bankers. It also brings a lot of financial structuring, modeling into the company. It also makes the balance sheet more logical and stronger for a banker to trust upon and take interest in.
True.
And that makes the entrepreneur very, very vigilant and disciplined and operating in a certain manner, also compliant from a tax perspective. Because I've seen companies paying better taxes and trying to not hide away anything because they are worried about a banker on the other side. So it is a
Exactly.
very nice
True.
positioning. So I would rather want to zoom in into that and try to ask or understand certain insights on how which type of debts are required to be taken and when those debts are logical to be taken by an entrepreneur. Um and when is the right point when one should go for that particular type of debt instead of the other.
Okay. Okay. So rightly concluded, Mitesh. Yes, debt seems to be a better option for small SME type of players and all those things where they would be the right decision makers for that sort of an industry. Now, coming to the products that you rightly said, I would divide those products technically into a further categories. So, if I divide the normal fund into basically either a term loan or working capital. So, a term loan basically that is either for capacity expansion or for a greenfield project or for a brownfield project. Just to, since it's a technical jargon, just to define in further expenditure, if I want to do a further expansion in my existing project, so where I already have a setup but I'm looking at adding additional lines of business or additional space for enhancement of my new products, that could be a normal basic capacity expansion that we are looking at a term loan for. When we say a greenfield project is a project which obviously will take a couple of years to get established. So when I say that the procurement of land, the construction of the building, the procurement of machinery, all those things technically require, depending upon again the industry, anywhere between 6 to 18 months to get the actual process done for the entire setup, after which the actual operations start, which takes another 3 to 6 months to stabilize and start generating revenue. So this is a sort of a greenfield project where people take a term loan, which is sort of a longer term loan of 7 years, say example with 2 years of moratorium. When I say moratorium, they have a moratorium period for not repaying the principal during that period and just serving the interest of the loan that has been taken. So that's a project that we can look at, a greenfield project funding for a new project that has been done by a promoter. Then there is something called as a brownfield project. A brownfield project is again a new project, but done by an existing promoter who has his existing cash flows in place. So that can be funded. So in this case, for example, you don't need a moratorium. I have my existing cash flows which can take care of the repayment of principal and interest. However, my project is in something different other than my I'm sorry, other than my existing project. So it could be not exactly an extension of your existing product, but it could be a backward integration or a forward integration. However, I do have my existing cash flows which can support them, and that is how the banks define or the funding institution define that as a brownfield project. So this is generally a term loan, which is like a long-term loan for your capacity expansion. Then comes to the heart of funding, which is your working capital business. The working capital business basically is to ensure that your procurement of inventory, your procurement of raw material, technically, your processing time, the amount that is required to be paid to the creditors, the credit that you get from the debtors. This basically determines your working capital cycle. And that is obviously the major amount of funding that is required by a company to run its show on a day to day basis. Now, breaking further down the working capital, again, there are various products. So I define that category into, say, fund based and non fund based. So when I say fund based, so we all are aware about cash credit, which is like which is normally backed by a drawing power, where you have to obviously submit your stock statement, which talks about your inventory, your debtors, as well as your creditors, and that is how the working capital cycle as well as the drawing power is determined, based on which you get a cash credit limit from a bank, which is normally used for all sort of your working capital requirements. There is also a product called as overdraft, which is an OD limit, which is supposed to be not backed by the drawing power. Now, these are certain places in cases like, say, just to example, a case like a restaurant. A restaurant or a hotel technically does not have the primary need because they sell everything on cash. Their procurement technically is on credit, and they do not have per se a working capital requirement, but they have requirements of paying their salaries to their staff, paying rents, paying a lot of other expenses and all those things which are supposed to be covered by the product called as overdraft, which is suppose is not supposed to be backed by, again, as I said, the other current assets which you are supposed to give them. So this is on the fund based side. Then coming back to non fund based limits, which are, just to give you a few examples, which are called as LC, which is letter of credit, bank guarantees, and various types of bank guarantees. Now, again, giving you just a glimpse about the letter of credit. Now, the letter of credit is again a non fund based limit, which is a document or a documentary credit, to define it in banking terms, which is given to a client for procurement of their goods. So instead of making the payment in a fund based limit through direct transfer and all those things, this is a sort of a documentary credit based on which the comfort is there on the other side, and there is a shipment of goods that happen. So again, various sort of LCs which we can cover up in detail at the later stages. It's like irrevocable LC, standby LC, etc., etc. Now coming to the bank guarantee. Bank guarantee, again, there are various types of bank guarantee. What we have generally heard is nothing but the bank guarantees that are given to statutory companies for their statutory purposes, like given to the commissioners, etc., which is called as a financial bank guarantee. However, there are additional sort of bank guarantees as well, which comes with a different business model. So for a guy who basically is in the EPC business, where it is more about the engineering, procurement, and the entire commissioning, so there are a lot of performance bank guarantees that come in place, where they need to provide a performance bank guarantee to the client whom they are going to provide their services. Then financial bank guarantee, again on the same side, where they can give an advance bank guarantee against the payment that they are receiving as an advance. There is also something called as a bid bond guarantee. Now these are the guarantees that are given in cases where you are bidding for certain projects. This generally goes very much in contention in the government tenders and a lot of other bigger tenders in the market. So this, when I say financial, performance, advanced bank guarantee, as well as bid bond guarantees, are the various types of bank guarantees that are available, which are required in a normal working capital scenario in different industries. So now coming to the different alternatives to finance, when I say on the fund based side. So if we discuss on the CC limit and all those things, but just to give you an inner side from the banking side, generally people have a slight discomfort on giving a pure cash credit limit, because obviously there is no control by the bank on the client on where the money is actually getting used. So there are a lot of, I would say, innovative products which the bankers as well are comfortable in lending and giving it to the clients. Just to give you a few examples on, so if there is something on the purchase side, so there is purchase invoice discounting. So say a guy who is procuring material from Reliance, the Reliance obviously based on that purchase and all those things, once he raises the invoice, the banker on the client's behalf can make the payment to Reliance and get the money in whatever is the decided credit period, say 90 days to 120 days. Now, what is the difference here? The client could have made the payment directly from his CC account to Reliance, etc. But a client is also comfortable doing this because for him, technically, the negotiation comes on the pricing. Say, for example, if a CC is working at 9.5% in today's market, there are banks who would offer around 9.25% for such sort of a purchase invoice discounting limit. They get a comfort that they are able to relate this transaction, and it is called as a transactional funding. So rather than the CC money going into somewhere else which was not tracked or something, this can be tracked. So there is an advantage to the bank that they are comfortable on the end use of the money. There is an advantage to the client that they are getting the funds at the cheaper rate of interest for that matter. So this was on the purchase side. Similar, there is something on the sales invoice discounting side where if bankers are more comfortable. So I will just add one instance here. What is sales invoice discounting on an unsecured front? So there is a lot of unsecured sales invoice discounting business done by banks. Now, I would have a limited comfort on a client who would be a 10 crore company, specifically having their assets and all those things which are limited, and there is a limited call that I can take on a client of this size. But the same client, if he's supplying to HUL, to Reliance, to say Sun Pharma, basically I have a lot of comfort on those clients where he's supplying to. And if I am able to see the track record, say for a last couple of years, where there are regular transactions happening on a very genuine basis and all those things, I'm very comfortable giving additional funds to this client based on the comfort that I'm also deriving from the customers to whom he's selling. Obviously, the recourse is still on the client. However, there is a lot of comfort that is getting derived from the end customer. So these are various stage, I would say, structured products on the fund-based side, where it could be PID, which I said as purchase invoice discounting, sales invoice discounting, and various other structured products related to the working capital. Now, obviously, if you talk about trade, I would put the same products in this purchase invoice in foreign currency. So the guys who are actually getting a foreign currency, so basically the just to share here that if it's a 100% EOU, export oriented unit, where their receivables are going to be in dollars, then there is an advantage for such clients to borrow their money in foreign currency, because I think there is a clear cut gap. Okay, that gap has reduced much today. At one point of time, before a couple of years, that gap was to almost close as 4.5%. That I used to get the foreign currency loans at around 4.5%, and the Indian loans, Indian rupee loans at around 9%. Today, that gap has already slightly narrowed, but still, there is still an advantage for an exporter to take the finance of his working capital in foreign currency and get the payments done from the receivables that is going to receive. So there is a lot of advantage in this sort of products as well. So depending, again, as I said, it's very customer centric, it's very product centric, but depending upon the business model as well as the promoter knowledge about the products, that is how you can actually get into the different sort of products, even in a working capital sort of limits.
Super. So this gives a very comprehensive idea on equity versus debt. I think if you are a very, very early stage entrepreneur, you don't have anything to mortgage. Also, you don't have any track record to prove. You go to your friend or a very, very near and dear relative or a father or even uncle and tell him, please give me 10 lakhs to start my business. Even that is equity. And at the end, if you list your shares and go to stock market and your IPO is listed and your uh, what you call market cap is 1,000 crore, even that is an equity. So at both these ends, when either you are starting or you are really matured, you go for equity. But in between, debt is a solid mechanism, has been having a proven track record. Yesterday, I was listening to someone. He was telling that the Indian debt book is around 3 lakh crores now, and it is bulging at a very, very high speed over a period of time. And he was telling that it has increased threefold in last 3 years, which is a huge jump in overall debt. And that means a lot of investor and entrepreneur confidence that business will grow, I will do better. And a lot of capex is also happening through the debt instruments. And that is where you can also see the banking industry flourish and large banks growing at a huge speed over a period of time. So a lot of value addition comes in the form of debt. In debt, one has to be very, very selective. We have seen that generally people go for term loan or working capital. That's it. They don't go for specific instruments. They don't go for studying what is right for them. They don't use any consulting in this area. And that's where they end up paying higher prices and getting lower than expected debts and always have a bad banking relationship. So they get into a suffering kind of a situation because to start with, they are unaware of choosing right path or right mechanism. So my humble advice is to uh, choose right products. You are an exporter, choose product accordingly. If you are a channel distributor, choose a product accordingly. If you are a real estate developer, choose a product accordingly. If you are a hospital or a hotel industry, choose a product accordingly. If you are an education institution, choose a product accordingly. That will give you a lot of leverage and advantage and also a lot of comfort to the banker. And by that means a lot of free finance or easy finance for you to grow, develop your dreams into reality. So with this, we would like to conclude today's session, and we would like to thank everyone for taking out time and listening to this video. Please make sure that you share it with relevant people who may find useful as well, like you found this video useful. And we will come up with few more series of videos on this topic of debt financing and product specific videos. Like for example, what is buyer credit? What is the SVLC? What is the BG? What are the various mechanisms in which supplier uh, can get a supply chain finance in the form of bill discounting or purchase invoice discounting or sales invoice discounting. What is this new model of trading in various debts and so on. So a lot of opportunities are available. A lot of mechanisms are developed over a period of time by the bankers, looking at the situations and how they can draw comfort, looking at various industries so that every industry in the country is financeable in a different mode, in a different model, sometimes fund based, sometimes non-fund based. So we'll discuss those nitty-gritties in the next coming videos. Thank you everyone, and please share this video and subscribe to our channel for more such relevant videos. Thank you, Tejas Bhai, for being on the show,
Thanks,
and
thanks a
we
lot,
conclude this
Mitesh.
show now.
Thanks everyone. Thanks a
Yeah,
lot, guys.
thank you. Bye.